everyone. Welcome to Down Payment Options 20% versus PMI webinar. We are going to give people a few, maybe a minute or two before we get the webinar started. So just sit tight and we'll start around like 12:02. Okay, everyone, I think we're going to get started now. So again, welcome to Down Payment Options 20% versus PMI. We're going to jump right into this webinar. So real quick, I just wanted to go over some webinar resources that's available to you. At any point during the webinar, you are free to ask questions that should be in a panel to the right side. Feel free to ask questions whenever you want. We have a Q&A section at the end that we will answer questions, but you can answer questions during the webinar at any time, so feel free to do that. We also have a free home expenses guide that you can download in the panel to your right. That's a free guide that you can download that just goes a little bit more in depth about different expenses to buying a home, and you can download that on your own free time. We will have 2 polls available in this webinar, and it's very intuitive to use. It will pop up on your screen. It'll be a quick question, and you can answer it. It'll be really fun, so keep an eye out for that. And again, if all the recordings will be available for this, if you have missed anything or if you have to leave at any point in the webinar, if you know anybody who missed the webinar for any reason, they'll get a recording as well. So just if you missed anything or want to listen to the webinar again, you will get the recording in your email after the webinar is over. It may take about an hour or so after the webinar, but you should get that. So I would like to present our presenter, Patrick Faulkner. He is a home finance consultant with Greater Alliance. Patrick started in the mortgage business in 2002 following his service in the United States Army. After 3 years as the supervisor and direct manager with Champion Mortgage, Patrick became an external mortgage loan originator where he consistently originated loans at the President Club level. For the past 10 years, Patrick has called Greater Alliance Federal Credit Union his home and has served in the membership as a home finance consultant, assisting members with obtaining financing for their homes. So basically, he's a very good expert on mortgages as a whole. So now Patrick's going to go over the agenda and kick off the webinar.
All right, thanks, Brian. Thanks, everybody, first of all, for taking the time to participate in the webinar today. What I'm going to do is basically just going to go over the agenda to begin with, and as we go through the slides, kind of summarize and do a little color commentary to help people absorb the material a little bit better, kind of break it down in a more friendly conversation type. I've found that in doing these seminars, it tends to resonate a little bit better rather than just going over chapter and verse and not providing too much explanation. So it's a better way of doing things. I'm just going to touch on it. And like I said, give a little bit of a color commentary. To Brian's point, any questions along the way that pop, please feel free to type them right in, and we'll jump all over them and get them answered as we go. Definitely makes for a more interactive webinar, which is what we're going for to begin with. All right. So for today, basically, we're going to just go over some down payment basics. I know it says here why you should put down 20% optimally. You want to put down as much as you can. That's going to, the more you put down as with anything you finance, the less of a monthly payment you're going to have. So we'll touch on that. The importance of a down payment, why putting something down is always a benefit to you. Here's the term PMI. It's actually private mortgage insurance. That's item number 4. We're going to talk about that, what that is, and how that plays a role. Again, that's going to kind of trail into item 5, important PMI info. then we're going to kind of shift over to some ways that you can save for the down payment and some programs that the Greater Alliance is running, some wonderful programs to kind of help the membership along with preparing themselves for buying a home. And then again, we'll review what's coming next down the pike from a future event standpoint and address any questions that anybody has. All right? So that being said, let's roll into it. Okay, so keeping it real simple, what is down payment? Well, for any of you who have financed anything, car, furniture, anything in the past, down payment is basically money you're putting down up front, in this case, as far as buying a home, that you're putting down up front to get a loan, okay? Obviously, it's a deduction from the total amount of what you're really going to be paying and what you're going to be taking a loan for. So to keep it simple, if you're buying a $100,000 house and you're putting, $10,000 down, that's your down payment. So now you only need, a $90,000 loan, and that's the way it goes. So with a house, you're already walking into equity. So you want to have a down payment to begin with. In the past, the rule of thumb is always, you want to try and put 20% down, and you do, even to this day if you can, but obviously, things aren't the same as they were back in the day. We are kind of, the economy is starting to come back, but the reality of the situation is we have just kind of come out of this generation's recession. So, I'm going to talk on that in a little bit, but, obviously, at the end of the day, when you're thinking about what to put down for a down payment, you want to put what is going to be able to serve you as far as what your monthly payment would be, obviously on a mortgage loan, but that you can still live. You know what I mean? I advocated for this in my last webinar. You got to be able to live and enjoy your life and your house and everything, and not put yourself in a position where, okay, I just spent everything I had on a down payment, and now, okay, I don't have anything left over. Decorate, furnish my house, do anything. So we'll talk on that. So what we're going to do real quick right now is a quick poll, all right? Real quick question having to do with how much people have started to store up, save up, just so we can get a gauge, and this is going to help us kind of navigate where we're going to go with the remainder of the webinar as far as some of the things we're going to talk on. So if everybody could take a quick minute, that'd be great. It's really just point and click, all right? And basically it's how much have you saved for your down payment thus far? If you're at that point now where we're starting to preparations for buying a home. Just point and click, hit submit, and then we'll talk from there.
One more second.
Okay, so looking at this, I'm actually, we got the poll results back. I'm actually happy to see close to 40% of the people participating in the webinar are already right around the 15% mark, so that's outstanding. And then we got a pretty even split over the 10 and 5%. So great, that's a great job for everybody who's participating in this, that we're already starting to put money away, because it definitely is the way to go. Unfortunately, 7 or 8 years ago during the whole housing crush, the problem was that people weren't putting anything down. So when the housing market fell apart, all of a sudden they found themselves underwater, and that's another reason, that's one reason right off the bat actually, why you always want to have a little something there, some equity in the property. We're going to touch on that in a bit, but looking at these poll results, that's terrific. So let's move on and really get into it. All right. So right off the bat, you're going to see a slide that says basically 6 reasons why you should have 20% down. I'm going to amend that a little bit, because there are lots of programs out there, and I don't want to scare anybody off. 20% down or better is certainly optimal, and if you can do it, that's terrific. But a lot of people can't. Okay, 20% down. If you just want to take that number, I was talking with some of my colleagues before we started this webinar. Even if you find a $200,000 house, okay, that's 20 grand. Okay. 40 grand. If you have 200,000, if you have even a $100,000 property, you're talking about $20,000. That's a lot of money. So, and if you're in New Jersey, you're not going to find too many $200,000 properties that aren't going to either require a lot of work or just, it's just not like that. New Jersey is a very expensive state to live in. So even a $200,000 property is going to be a $40,000 down payment, and you're not even talking about closing costs. So the reason I say that is because I don't want anybody being scared away or saying, oh, if I don't have 20%, there's no point in me even doing this. Nothing can be further from the truth. All right, I'm going to go over that and kind of illuminate that a little bit in some of the future slides we're going to review. But if you can do 20, that's great, and the reason for that, 20 is the threshold that delineates the need for any kind of what they call PMI. Okay, we're going to touch on that in a second. If you have 20% down at the time of a purchase, you do not have to worry about PMI. Okay, but if you have less, don't worry, and we're going to talk about that next. Okay. All right. You know, in the past, as you know, improved chances you will actually get that mortgage if you have 20% down. That was kind of a thing in the past. Okay. I want to address this a little bit. The reason for down payment right off the bat, the reason with any loan that everybody needs to know right off the bat, that if you're a lender, okay, what you're looking for is simple, risk delineation, okay? The less risk, the more comfortable a lender's going to feel, which is why they also look at your credit score, okay? Obviously, somebody with an 800 credit score has demonstrated that they have the capacity to manage their finances and their bills and so forth. So if I'm a lender and I'm saying, okay, I say 800 credit, I feel better. I feel better right off the bat. Just seeing that than say maybe somebody comes in with 600 credit. Okay, obviously. All right. Same thing, like I said, with down payment. If you're putting a little something down and you're not having a lender finance 100% of it, which by the way they don't do anymore, you're sharing some of the risk. You're taking some of the risk off the lender's shoulders, and for yourself, you're giving yourself equity right off the bat. Okay, so it's about risk delineation. Now, in the past, the banks wanted 20% down. That was kind of their comfort zone. There were different loan programs for different amounts down. A lot of it has changed and fluctuated. The one thing I can tell you, a little bit different than what the slide is representing here, because some of this data is a wee bit outdated, is that the only thing that banks really aren't doing at this point is 0% down. You gotta have something down, okay? And there are programs where you can do 5, 10% down, even 3% down, which we're going to go over in later on in the webinar. But 0% is a no-go. Okay. At this point in time, that was one of the problems again during the whole housing crash and the mortgage crash, was that people were putting nothing down. So when it came to the point where they couldn't afford it anymore, they walked away, and it was no skin off their nose. They weren't losing any money because they hadn't put anything down to start with. And a lot of lenders got jammed by that. So at this point in time, you got to have some skin in the game, proverbially speaking. So that's where we go from there. Okay. Now the other thing, and we talked on this in the original seminar, and I'm sure that we did for first-time homebuyers, and I believe my colleague James referenced this in last week's webinar, was that the other thing is you got to be able to afford the monthly payment. Okay. And basically the way that Fannie Mae, which is basically mortgage talk for the government, if you will, says, hey, listen, at the end of the day, the way we're going to qualify somebody for a mortgage is that the monthly payment, along with what they're paying month to month on their credit report. Okay, so let's say you have a car payment for $200, your student loan payment for $100, and then you have your future projected mortgage payment, and that's $1,000. All right, so as long as you add those together, you get $1,300. As long as if you're making whatever you're making, it doesn't exceed 43% of that gross number, you're fine. So to use a simple example, and I used this in my original webinar, just use easy numbers so nobody needs a calculator here. If you're making $10,000 a month, and they say, okay, 43% is the max we can use to qualify you, and I teach this at my seminars and webinars, $4,300 would be 43% of 10K gross, okay? You draw a box around that number, 4,300. So all that means to qualify is simply this. Whatever the projected mortgage payment is going to be, plus whatever you are paying month to month on your credit report, if you add those together, as long as we don't, I joke, I said don't break the box, as long as that number wouldn't add up to more than $4,300 in this little scenario, in this example, you're good. So as it pertains to the individual, for those of you listening, if it's you take 43% of your gross monthly income, draw a box around it, and say to yourself, okay, my mortgage payment plus whatever is showing on my credit report, not the balance, just what you pay per month, those monthly payments, be it credit card, student loan, again, what have you, car loan, as long as I add those all up with the projected mortgage payment, and they don't go higher than that number in the box, you're good. If it's you and a partner or spouse, whomever on the application, you're going to do the same equation. You're simply going to take both your gross incomes, 43% of both, add them together, and put a box around it. But then, again, it's going to add up to what you are both showing on your prospective credit reports. You just can't break that number, okay? And that's designed to protect people. A lot of people are like, I'm really not liking that, but it's designed to protect people because, again, during the whole Wild West lending era, what was happening was people were taking mortgage payments that were 55, 60% of their gross monthly income, and they had no way they were going to manage that, okay? and it led to people losing their homes. So that's the whole qualified mortgage rule. All right, so moving on. All right, here's the deal. Again, not to go too heavy on this because we kind of talked about the opening, and for those of you who have financed anything in your lives, the more you put down, the less of a monthly payment you're going to have. It's a simple ratio. Just like when you go, when I teach people about mortgages, I talk to them like, hey, listen, when you go to a car dealership, you go there with a set amount of money in your pocket. You go to the dealer and you say, listen, this is what I want to put down because I need that car payment to be X amount of dollars so I can manage it month to month. Same thing with a mortgage, okay? Unfortunately, a lot of people get freaked out. They hear the term mortgage, or they hear some of the jargon that goes with the industry, and it just sets off a level of uncomfortability, a recoil. It's kind of inadvertent, but part of what we do here, especially at Greater Alliance, is we're going to hold your hand through this and delineate as much of that that stress and/or anxiety. We want it to be a good experience. Buying your home should be a wonderful experience that you're excited about. So do not worry about that. We're going to hold your hand through it. But just hearkening back to this, obviously, the more you put down, you have control over how much of a monthly payment, excuse me, that you want to have. So the more you put down, lower the monthly payment. Okay. Okay. Here's the other thing. All right. There are ways to nip at the interest rate that you're going to receive on your mortgage. Okay. Obviously, putting more down. Okay. Having a higher credit score. These two are a nice combination to kind of whittle that interest rate down. Okay. The interest rate on a mortgage loan is predicated upon, hey, where is the individual's credit score at, and how much are they putting down? So somebody who's got an 800 score and putting 20% down stand to receive a better interest rate than somebody who's got maybe a 650 credit score and they're putting 5% down. Okay, which is more risky to me, the lender? Obviously, the person who's putting very little down and has a bit of a roughed up credit score. You are more of a risk to me than somebody who's like, hey, 800 and I'm putting 20% down. Yeah, I'm certainly going to feel more comfortable with that. Okay. Now, it says here on this slide, the interest charge on a loan with 20% down is often lower than, this kind of goes to what I was just saying, okay? But to keep it simple, and a lot of this is common sense, folks. I know you've all done some kind of financing to one degree or another. Your credit score is the tip of the spear, okay? So the better it is, the more power you're going to have from a negotiation standpoint, and obviously the more you put down, again, you're looking to delineate as much risk on the lender's side as possible, and we're going to come back to you and say, hey, listen, love what we're seeing. This is what we want to offer. We want to make this work, and again, we want to have a real nice transaction. Okay? All right. So, moving on, the dreaded PMI. Let's talk about it. Okay? Listen, private mortgage insurance. A lot of people see it, and they look at it, and they say, "Oh man, this is going to be a deal slayer. It's not going to work out." It is not designed to crush a deal. Okay, let me say that again. PMI is not designed to crush a deal. All right. Basically, to give you the street level of terminology of what it is simply designed to insulate the lender, okay, in case of a default. That's all it is. It is a temporary thing. All right. It's basically an additional premium that is added on to the monthly mortgage payment until such time as you have paid that loan down to having 22% equity in the house. Okay. Now, some of you might be saying, wait a second, I only got to put 20% down not to have it at time of purchase, but you're saying if I put down less than 20%, I got to wait till I get down to 22% to have it go away. That's correct. Okay. So if you can do it at closing and you put 20% down, you don't have PMI. However, if you only put 10% down, you do have PMI. What it is an added premium, like I talked about. It's a temporary fix. The lender does not apply this. Okay, it is set up by an external mortgage insurance provider. Okay, and the way it works, it's just an added payment. It's an added premium to your monthly mortgage payment, and it stays there until you've paid the property down to 22% equity in your favor. Okay, once you do that, it goes away. It's a temporary thing. Now, not only is it, again, a protectant for the lender in case of default, in many cases, it is an incentive. You can always pay more on your monthly mortgage payment, all right? A lot of people are like, okay, there was a theory or a fear in the past that if you paid more, you were just paying more interest, or prepayment penalties or things of that nature. You can pay as much as you want. If the agreed upon monthly mortgage payment is $1,500 and you send $1,550, well, that $50 goes right to principal. So you always want to try and send a little bit more, and you can knock down the equity that you need to get to and make the PMI go away. All right. Again, It's just a small form of insurance. It does not slay deals. I will tell you, on an estimated $250,000, you know, a PMI premium might be $90. Okay, it's not like they're throwing another couple $100 on your mortgage payment. It is just there to protect the lender and to incentivize you to stick with it and try and get that out of there. All right. Okay. So, you know, talking about just, you know, some of the benefits of being able to put some, you know, money down. We kind of touched on this a little earlier. You're walking into equity in the home. It's yours. Okay, you own a piece of that property, and there is a psychological aspect to that that, you know, for lack of better words, makes you feel good. All right, like, hey, not only did I get a loan against this house, it's mine. I own some of it. So you want to put some down payment there because, you know, your home is your castle, and you want to keep driving forward. And you know, that is the benefit. You're walking into something where you have equity in a property, as opposed to renting. You know, when you're renting, basically the money's just going out the door, and you're not building anything. Okay, when you have a nice down payment, and then you get into a mortgage and you start paying, you're owning more and more of that house each time. Again, you want to put down what you can, but if you can't do 20%, that's okay. We have programs. We're going to talk about those in a couple minutes, where, you know, even as little as 5 or 3% down, and we can get something going. You just have to make sure and understand the balance, okay, that comes with, you know, the less you put down, the higher the payment's going to be. So, again, it's a balancing act. Everybody's situation is different. I'll be the first one to tell you, you know, maybe you have money down for 20%, but if you just do 15% down, well, I got 5%, and that 5% might be 10 grand that can be used for doing some work on the house, decorating the house, moving, you know, this and that. So you want to find that balance. You want to have, you know, your life. Okay, there's a term called house poor, where everybody dumps everything they can into the payment, and then they didn't save themselves anything for moving in and making the house look the way they want it, and they're just living in this house, and you know, 2 of the rooms aren't furnished. So things like that. Okay, find that balance, and again, we're here to help you with that. You know, that's how we take care of our people. Sit down, give us a call, or, you know, come in and we'll meet and say, listen, let's put a game plan together that's going to make you feel like, hey, I got my house and I'm happy, and I'm also happy with how I'm running my life. Okay? So, moving on. We already kind of touched on this, so we're not going to, you know, dwell on this slide. As I spoke to it, why do lenders require a down payment? Risk delineation. Simple. Okay? The more you put down, the less money the bank is lending, the more comfortable they feel. Straight, you know, pretty straightforward. All right. Moving on. Okay. 3 good reasons for putting less money down on the home. Okay. You know, I can summarize this basically by saying, listen, you want to be able to live your life. You want to get into the house, and you want to have a monthly mortgage payment that you can afford, but you also want to have your life and enjoy your life. Again, it's about balance. You want to put some money back. You want to put some money in, definitely. You know, and this kind of applies across the board, whether you're putting, you know, 10, 15, 20% down. Home values fluctuate. Okay, I'm going to jump right to the second one. You know, home values fluctuate, I said, and that's the big key there. There are going to be times where the housing market blows up, and, you know, you're looking great because, you know, the equity that you may have put in, you may have put 10% down when you first bought the home, and it was valued at $200,000. Well, now it's valued at $250,000. All right, so now you have that much more equity. There are other times where the market tightens up a little bit, it contracts. But if you put money down, even at a point where the property was worth a little bit less than what it was, you still are above water. Okay, that's part of the reason that the mortgage housing crush happened, you know, almost a decade ago now, is because people were putting nothing down, taking out a loan, and then the housing values dropped, and all of a sudden people were underwater. In other words, they owed more than what the property was even worth. Okay, and on top of that, they had rates that were fluctuating. Some of them got in arm loans. So it was a total crush across the board. So you want to have something in there. That is really the number one. It's an insulator. That's the number one reason. Okay, you know, down payment, like I said, you put some money down. Again, it's all about balance, and it's all about comfort and manageability. You want to have a life. You want to have a home, and we're here to help you with that. Okay. All right. What is PMI and how it's calculated? I know I kind of drafted in all this because there's such a mesh between these slides, but basically it's an added premium, okay, designed to insulate the lender against any kind of default. The fees, you know, they do vary from 0.3 to 1.5. I can tell you this, it's underwritten the same way a loan is, just to summarize this whole screen, okay? They look at your credit score, they look how much you're putting down, and they draw what the premium is going to be based off of that, okay? Again, you have 800 credit and you're putting 15% down, the PMI per month might be 50 or 60 bucks, okay? If you have 680 credit and you're putting 5% down, the premium might be $115. So just to give you a gauge, and I know a lot of you guys are understanding what I'm saying because this works almost, this methodology is almost universal when it comes to financing anything, okay? Again, hearkening back to what I was saying in the beginning of the webinar, strong credit score is the key, that is the tip of the spear, and then, whatever you can put down, you do what you can do, okay? And that's pretty much how it works. Just remember that it's not, because I have had people call me and say, all right, Pat, what's the PMI going to be? I need to know, like right now. I couldn't tell you, because we don't underwrite it at the credit union, and because it is predicated upon a credit score and a down payment. There's no set rate sheet, okay? So that's pretty much the point I want to make with that. Okay, how do we pay for PMI? Basically, the way it works, the most common way, is it's simply rolled into the overall mortgage payment, okay? You're going to, when you get the estimate, when somebody comes through and does a mortgage, application with us, we're going to give them what's called a loan estimate, okay? It used to be called the good faith estimate back in the day. Now it's called the loan estimate, and it's going to break out everything associated with the loan, from all the closing costs to what the payment's going to be, and a very explicit breakout to the payment, and you will see it itemized there as an estimated PMI premium per month. We're not going to know, again, until we get you in underwriting and we send it out to the PMI company to review, but you'll see it estimated there. Basically, the way it works is it's simply rolled into your monthly payment. Okay, that's the easiest way to put it. There are some programs where you pay some of it up front. FHA program has you pay a premium up front as part of your closing, an overall premium. But at this time, we're not doing FHA loans. I just want to outline and illustrate to you the differences. Primarily, like I said, when you begin a loan with Greater Alliance, the way it's going to work is it's simply going to be factored in your overall monthly payment. We're trying to make things easier for you. The last thing we're going to want is say, hey, listen, you're going to pay us X, and then P.S., send this part of your payment over to this company. Okay, we take care of everything for you in one stroke, and it'll simply be factored into your payment. That's all you guys really need to know from this screen. Okay, not to go through and read every bit of this because I don't want to put anybody to sleep. What factors should you consider when deciding whether to choose a loan that requires PMI? The long and the short of it is simply this. Every loan will require PMI if you're not putting 20% down, okay? Plain and simple, okay? It doesn't matter whether you're doing an adjustable rate mortgage. I have had people ask, hey, well, if I do an ARM loan, am I going to do a PMI versus a fixed? Yes. If you're not putting 20% down, you will deal with PMI. So, factors to consider, again, like I said, and this goes to the home buying seminar that we spoke about at the webinar a couple weeks ago. Before you even get into this, you want to plan, okay? You want to plan, you want to prepare. I tell people it's like playing chess, okay? You want to be thinking a few moves ahead. You want to plan everything out. And what I mean by that, as it pertains to this particular type of transaction, is simply this. Look at your credit score. Go through it. Print out a credit report. Make sure that everything is tight. Make sure that there's not something silly on there that is jamming your score. And, hey, I had a Blockbuster video I didn't return from 92. And it's been sitting there for $15, and it's been dogging me for over a decade, and you didn't realize that you'd have an 800 credit score if it weren't for this one silly thing. Those of you now know how old I am by the Blockbuster comment. The point being is this: check your credit. Right? There's so many times where even somebody who is diligent and fastidious with taking care of their finances can have something pop, whether it be something silly. You went to get a physical with the doctor, and whatever. Somehow it popped on your credit report and it's doing unnecessary damage. You want to come as strong as possible, okay? Same thing with debt, okay? Again, if you have external debt, credit cards, any kind of loans you have, your Beer of the Month Club, your Salon of the Month Club, whatever, try and knock down that debt, okay? Make yourself look as strong as possible, and start saving early. All right, like I said, I'm glad in looking at the poll that a lot of people are looking at 10, 15% saved already. That's outstanding. That's a hell of a job, okay? Because if you just walk into this, no, I don't really have much saved at all. Again, you're walking into a gauntlet. Like, buying a home is not a quick hit, let's go do this right now type thing. Unless you pulled off a lottery victory, okay? And even then, I would tell you, hey, listen, now you got all the money, great, make sure your credit score is strong. There's no point in getting an interest rate that's higher when you can do something to prevent that from happening. So, as far as what factors you consider deciding whether to choose a loan that requires PMI, listen, I would amend this whole slide to simply saying, do some work ahead of time. Okay, play it like chess. Be 3 moves ahead. Come ready, and not for nothing. If you have any questions, that's what we're here for. Okay, you guys are our members. Part of the job is not just, hey, let's get you some money or get you this loan or whatever. We really, really do adhere to the ideology that you're our people, you're our family, and we want to help you, counsel you, prep you, get you ready, and make it a great transaction. Like I said, buying a home should be awesome. Everybody should be stoked. I am getting a house, it's going to be my own place, my castle, I'm going to decorate it, I'm going to do this and that. That's how it should be. Not, what are they going to look for next? I don't know if my credit score is where it should be. Have I saved enough? I'm starting to wig out here. That's not what we want. Okay? So, let us help you. Come to us, and like I said, we'll walk you through the whole thing. All right. After that long-winded blowout, moving on, next one. Okay, so disadvantages of PMI. Listen, nobody likes to pay anything extra than they need to, right? That's how you kind of summarize it. Once you're in it, like I said, you want to pay as quickly as you can, pay down that balance on the loan to get rid of it. But again, nobody likes paying extra money when they don't have to, okay? But the reality of today is that not a lot of people are ready with 20%. Like I said, I use the analogy, even a $100,000 house, 20% is 20 grand on a $100,000 property. There are no real nice $100,000 properties in New Jersey. Let's be real. So, if you can avoid it up front, great. If not, try and send a little bit extra, in your mortgage payment each month. You believe me, it adds up. Like anything else, saving, whatever, it adds up. Even $20, $30 on top of a monthly mortgage payment, you're paying it off through the year. A few $100s extra per year, you're knocking down that balance, and moving closer and closer to delineating the PMI. That's pretty much it. Okay. So, move on from that one. Let's talk about some fun stuff. Saving for down payments. Who doesn't love that? So, all right, listen, it's been my experience, and I've read a lot of articles on this. When it comes to saving, the easiest way to do it is to not see yourself doing it, okay? And that brings us to the first one, which is basically, a savings account, all right? Set up a savings account, and if you can, have money automatically move to it. You don't have to do it. You can't see it, but it's just happening. For me, I'll tell you, when I did it, that was the best way for me. Okay, I knew I was saving, didn't want to see it. I knew it was coming out, and I was not tempted to touch it, no matter what I would rationalize to myself. Oh, it's an emergency. I'm just going to, dip into this real quick. No, don't do that. It is the best way because it's just happening, and you don't have to worry about it, and you know it's happening. There's a couple examples on here that are a little more hardcore. Skipping vacations for a year. Listen, I would just dial that back to say, like anything else, when you need to save something and you have a bigger goal in mind and you're trying to keep your eye on the prize, it requires sacrifice and discipline. That's all there is to it. Am I telling you skip a vacation for a year? No, not necessarily, unless it's something that you feel prepared to do. Like, again, I'm a big advocate for, people should be able to enjoy their lives, okay? Everybody's working hard out there, and everybody deserves, to detach, okay? Decompress a little bit. So I'm never going to hear me tell somebody to skip a vacation, but you can summarize that one to listen. We all tighten our belts a little bit and keep your eye on the prize for the ultimate goal. If it means skipping a vacation, I'll tell you what, I've done it. Okay, I've done it for other reasons. Okay, with family and this and that. Like, hey, listen, this year we want to do this for next year. We're saving for a nice vacation next year, or whatever, or we're saving for a new deck, or we're saving for and it happens. But that doesn't mean you can't do other little things. Okay, lowering your expenses. Hey, listen, you should be doing this on a daily basis. Okay, whether you're trying to save for a house or not, always quarterly at the very least, take a look at what you're paying out. I do it on a personal level, car insurance. Well, let me take a look and see what's out there. Somebody's always looking to save money and this and that. Go through, see what you got, see what you can reduce. Could be something as simple as, I love my Dunkin' Donuts coffee. I'm going to save. I know I buy coffee every morning, 5 days a week. I'm going to scale it back to 3 days a week. Okay, that's hard, at least for me. So listen, joking aside, whatever you can do to kind of skim off the top on the expenses, look into it, see what you can do. Again, this is all about discipline, it really is, and commitment. Reducing interest rates. If you have something else that you financed, listen, it never hurts to call and say, can we do anything about this interest rate? You know, the worst case scenario is they say no, okay, whether it be furniture, whether it be a car, whether it be whatever. Can't hurt to ask, okay? Worst case scenario is they say no. You miss 100% of the shots you don't take. So, you know, calling and saying, hey, listen, can we do anything about this? They might say, yeah, okay, you know, you've been with us for a while, you've done, you know, for your car, right? Hey, I've bought 3 cars with Toyota. Now I have this one I'm financing. The rate's this. Can we nip at this a little bit? Like, I do believe that people do like to help people. Okay, I do have faith that that is an inherent quality in human beings. And you go to somebody and say, listen, this is what I'm doing, and you level with them. I'm trying to save for home. Can we do anything about this? I believe that most times, if they can, they will. Okay, and if they can't, they'll tell you, and at least you know. Borrowing money. Okay. You know, again, if you are in a position, or you're part of a family, or a circle of folks who have the ability and the capacity to help you out, hey, gift funds are acceptable when it comes to doing a mortgage, okay? And if you are blessed and in a beneficial position where somebody can help you, sure, why not, okay? Borrowing from a retirement plan, I'll tell you what, this is a big winner. For those of you with a 401k, you can borrow from a 401k, and the best part about doing that is the monthly payment that you pay back on that loan does not count against you, because you are paying it back out of your, out of your monthly pay from your job. So a lot of people who buy homes for the first time utilize funds from a 401k. They take a loan against the 401k. It doesn't affect that debt ratio we were talking about, that 43%. It does not factor into that. So it's almost like free money. And you can use that as a down payment, and it doesn't count against you. It is a huge and very beneficial way that lots of folks get into a home for a first time. So that's definitely, I would put an asterisk around that one, okay? Okay, rounding out the final 4, if you will, okay? Lots of different ways. Obviously, if you have investments, I have people who have stock options. They might sell some of those for some funds to use as down payment. That's fine, as long as we can source it. Number 8, pretty much a common sense one. You're looking to bring in extra money. I have folks who do a second job. Folks who are like, hey, Patrick, I work at, AT&T here, and then on the weekends, I work at a restaurant. I cook in the back, I bartend, I wait tables, and I'll augment my money that way for savings. So you can do that too. Number 9, negotiating with the seller. Hey, listen, and I used this example at the webinar that I did 2 weeks ago. Whatever the seller is offering their home for, obviously you're not going to say, if they're selling it for $350,000, you're not going to say, okay, $350,000. Just like when you go get a car, the dealership might say, hey, that Jeep Wrangler there is $18,000. Well, you're not going to walk up and say, okay, $18,000. No, you're going to say, how about $16,500? You go to the seller, hey, listen, you're offering for $350,000. How about $320,000? All right, right off the bat, it may not seem like much, but $30,000 is a lot in a loan. If I told you you had a loan for $30,000 and I turned around and said, now you don't, it's gone, you'd be doing cartwheels. So $30,000 is a lot, and it translates over to a monthly payment. Or, just from a closing standpoint, many times sellers will do a concession. They'll say, listen, if we can close this deal by such and such date, or if you accept this sales price, I'll throw $5,000 toward the closing costs and kind of lighten your load. Because maybe that seller is looking to retire, maybe that seller is looking to get out of town, or there's something on the seller's side where they need to have expedient transaction, and they're saying, hey, listen, let me help with this. Or maybe the house has been on the market and nobody's wanted it, and they're really eager to sell. So, your realtor can help you with that, but, there's seller's concessions, there's, getting it at a lower price than what's offered, lots of different ways, okay? And best of all, number 10, which is why it's a huge number 10, is Greater Alliance's Home Buyer Savings Program, okay? And we're going to talk about that. Basically, it is a program where Greater Alliance is allowing, as a special savings program established, where you're putting in a minimum amount of money over a fixed period of time, and there's a yield that is being given back. And I'm going to touch on that in just a second, as far as that goes. Okay, so here we go. Basically, like we talked about, the home being one of the biggest financial purchases you can do. Greater Alliance is always looking for ways to help out our people. All right, you guys. People are our lifeblood, so, you know, this is what we want to do. And essentially it works like this, okay? It's a home buyer savings program that can help, you know, it can basically help you save, you know, $1,000 in credit toward your closing costs, okay? 4 easy steps. It doesn't get much easier. First step being is that there's a web link where you can sign up for GreenPath's Home Buyer Counseling and Education Program. It's actually a wonderful program. It's very, very, it's very detailed, but it's very, very easy to follow. Not some big, long, thesis-type cost program. Actually, it won't take you more, I don't think it takes an hour to go through. But basically, gives you some tips, some guidance, counseling, much like the webinars we're doing here. A little bit more detail that you can see in front of you to help you out. Okay, so you got to do that. Next is, number 2 is getting pre-qualified for a mortgage with us, which you're going to do anyway, so you know, not even really a requirement. We're hoping you're going to come work with us. And the first step that we're going to do is sit down with you, go over everything, do a mortgage application with you, and get you pre-qualified. Now, for those of you who missed the original home buying webinar that we did, pre-qualification letter is what you need to go out there and be able to shop for a home, okay? If you aren't pre-qualified, it doesn't matter who you talk to or how many open houses you go to, nobody's going to take you seriously. Sellers are not going to spend any, or excuse me, realtors are not going to spend any time with you to take you to look at houses without being pre-qualified. And if you have any questions, please give us a call. We can go over that in more detail. I want to kind of stay on tack with what we're doing with this webinar. Okay, so basically, here's how it works. You come in, like when you always come into one of our Greater Alliance branches to do your banking, and you're going to open up a home buying savings account, okay? And all you need to do is save about $100 a month for 15 months. And there's a yield, there's an annual percentage yield of 0.15. We're going to add to that. And on top of it all, when the time comes and when you are ready to buy a home, you're going to have money saved with us that's going to help you for your closing costs and everything. And there's going to be $1,000 credits for the closing costs on the mortgage. So it is a huge home run. Again, it is a textbook planning ahead, playing preparing ahead of time, playing it like chess, and putting yourself in a stronger position when it comes time to do the deal. Okay, and it's a terrific program. There is really no downside to it. It doesn't cost you anything. We're just looking to put something in play to make that transaction that much easier for you. Okay, if you do have any deeper questions, again, I invite you to type in as we're rocking here, and we'll address them as we go. All right. All right. What are my other options? Well, let's go through it. Okay. So right now we're going to do another quick poll here with some questions, and you'll see where we're going with this in just a second. I'm going to ask you to just go through and click off again, point and click. It's basically going to say, hey, when are we looking to buy a new home? And this again will help us kind of gear where we're going with some of our webinars and where we go to for the remainder of this webinar. So if you could just go through, take 10, 15 seconds, and let us know, because depending on where you are in this time cycle can impact some of the things that I go over with you. All right, so looking at the poll results, here we go. When are you planning on buying a new home? So far it looks like the vast majority, we got about a 50% ratio within the next 6 to 12 months. Excellent. That actually fits perfectly with what I assumed the answers might be, and here's why. We are approaching what in the industry is known as mortgage season or selling season, and typically it runs from right around Memorial Day through to about October. And the reason for this is obviously it's nicer out and the flowers and everything starts coming out, so houses look really nice. And most people want to get in and situated if they're going to buy a home, obviously prior to the school year, especially if you have kids or you're planning on having kids. And they also tend to do it over the summer when things are a little bit calmer. So the next 6 to 12 months will fall perfectly with where we are basically in the annual from a mortgage timetable standpoint. Some people are looking, some 12 plus months out. Hey, good. Again, also a good answer. You're planning ahead and saying to yourself, okay, listen, you may not even realize it, but you're planning ahead already just by talking and participating in this webinar. So I commend you for that, because you're already saying I'm taking the steps to get squared away for something that is a long-term goal. So again, excellent. Some people are looking to get this done in the next few months. Great. I bet they probably fall in sync with the folks who have illustrated that they have a certain amount of money saved. So again, terrific results. I'm really happy to see this, because it shows that a lot of people are really doing this in a very proactive manner, which is great. So moving on, okay. All right. Now, as we talked about before, it is difficult in this day and age to come up with 20%, even 15, 10% in some cases. There is a new program that Greater Alliance is rolling out, and I have a colleague of mine, his name is James Goodman. He did last week's webinar. He is the grand master, if you will, of this program, but he has trained me up pretty well on it, so I feel comfortable talking about it. It's called the HomeReady Program, okay? Essentially, to bullet point the features, here's how it works. You can put as little as 3% down, okay? All right, 3%, all right? Basically, that is the huge win, okay? As far as the down payment and where it goes, even the source of funds for that 3%, okay, very little is even needed to be from the actual borrower. What I mean by that is you can actually have gift money. We talked about that in the prior couple slides as far as down payment money goes. It can come actually from somebody else, okay? Typically in the past, with Fannie Mae guidelines when it came to mortgages, they wanted the money to actually be, or at least a percentage of it, to come from the actual borrower themselves. There was no 100% gift money for down payment. You had at least some of your own money in there. With HomeReady, they're saying, hey, listen, if you have a viable source, somebody will lend you some money, we're good with it as long as you put at least 3% down. Additionally, the mortgage insurance, it's a little less, okay? It's a little bit more amiable to a person's financial situation. They will get something in there, but it's not going to be as much, okay? And as far as the policies for when it can be removed, it kind of depends on the situation. If you have property appraised up over a certain value, it can go. With typical PMI, and I didn't mention this before, but it's important to mention it now, when you do your conventional PMI, you have to have it for at least 1 year, okay? So even if you were to win the lottery and say, okay, I'm paying this down, the initial policy has to be in place for 1 year. That is the requirement for them doing PMI and going through the process of setting up a policy. And I apologize for not referencing that earlier, but thankfully this slide kind of brought that to bear, because with the HomeReady, I believe there are other guidelines where it can come off in less than a year depending on the situation. But for lack of better words, basically the HomeReady program, the big win here is they're pretty flexible on your FICO score. So if your score's a little roughed up, that can come. They look real hard at that to try and help you out. You can put as little as 3% down. You do not have to be a first-time home buyer. Okay. Again, we talked about how the mortgage insurance can be canceled. There are gifts, grants, things and so forth that can be used. It doesn't all have to come just from the borrower. As far as what they mean by non-traditional credit, they'll look at everything on your credit profile. So like I said, this kind of bleeds more toward what I was saying. If somebody's FICO score is a little bit tarnished, they'll look at other factors to say, okay, well, we really want to make this work. What happened? Okay, and they'll sit and they'll talk to you about it and see what they can do to make it work. Even manufactured housing and the like, if it, home style renovations, things like that. That I don't want to go too deep because I don't want to confuse anybody. That one is case by case. Okay, and we can talk about that if you have any questions. All right, so that's pretty much the HomeReady bit. All right, and the only thing I caution on the HomeReady thing, and we're going to go on to this next slide in a second. The last thing on the HomeReady thing is this. Remember about the balance. Okay, 3% down, 5% down. That is going to lead to a higher payment. A lot of people see that like, sweet, 3% down or 5% down. That's for me because this way I'm not coming out of pocket too much. Just remember, your mortgage payment is going to be higher. Okay, so always seek for that balance. Again, please feel free to call us with questions. Type in on this with questions. Come visit us. Come to the branches. We always have somebody here who can talk to you about that. Okay? All right. That was the last bit I wanted to just talk about on that. Last thing. The other thing that, again, Greater Alliance is just, pulling out all the stops to take care of our folks, and we really want to push and get people, in a position where they own their own homes and they're making strides in their lives. There is a $500 gift card, okay, that we are offering at closing. It's a limited time offer. It is only on purchase loans, so folks trying to refinance, I'm afraid this one doesn't apply to you. And basically, if you apply now, okay, apply for a mortgage now through the end of June, because like I said, we're approaching that the hot mortgage season for the year, and close by the end of September, again, that's mortgage selling season. You can take advantage of this offer. Basically, summarize, you get a $500 Visa card at closing if you apply before June 31st and close by September 31st, okay? It's there for the taking, all right? And I'll tell you what, $500 after you just got the keys to your house, you said, okay, listen, $500, that's somebody come in and paint, somebody do some work, or it's just money to have, and hey, listen, let's celebrate the fact that we just bought a home and go out to dinner, I know I did that when I bought my first home. I was like, sweet, okay, I'm going out now. I got my own home. I'm going to go celebrate. So lots of amazing programs, lots of products and so forth that Greater Alliance is trying to put out there to take care of our people with. So I know we only had an hour here to talk. Again, I want to thank everybody for participating. Any questions, please call us. Please come in. Send us emails. That's what we're here for. And we'll be there to take care of you, okay? As far as future webinars, let's talk about that. We have 2 more, the next 2 consecutive Wednesdays. One's on the 23rd, where we're actually going to break down the actual buying process and the closing process, basically like, okay, I've got a house, I've got a contract, how's this going to work? What are you going to do with me? And then how's this closing going to work? It's going to be a great one, full of details. I think it's going to make everybody feel real comfortable and have a better understanding. Then the 30th is going to be renting versus buying, okay? A little bit of a sidestep, but again, good for everybody to know, all right? So again, I want to thank you again for coming out. I love doing these webinars, and if there's any questions, by all means, please ask. All right, so first question, can my parents give me money for the down payment? Absolutely. As I said before, this should be categorized as gift funds, okay? So what that basically means is what we do is we send a letter, it's kind of like a one-page form, and it says, you fill it out with your parents. Like I, Mr. Smith, do hereby, and the lines are actually blank for the names. It's that simple. It looks like like a worksheet you got when you were in grade school. It says I, Mr. Smith, do hereby give, and there's a blank line for the amount, like $10,000 to, and then another blank, my daughter Addison, blank, and it just says, this money is a gift and is not required to be paid back, and both parties sign it. It really is that. That's how we verify that it's gift money, because if it's not broken out like that, then it has to be applied as a loan, and then we have to figure out a payback method, and we've got to factor it into that 43% debt ratio. So pure gift money can come from parents, absolutely. Okay. Let's see. Next question. Does it matter how much I get from my parents for the down payment? No. Again, if you're blessed enough that you have a family member who can help you with that, sky's the limit, I guess. I've seen folks give 5% down. I've seen folks put 50% down. Very affluent individuals who are just in a position where they could do so. But it's got to be close family member. Just let me clarify that. Your buddy down the street cannot lend you money. It's got to be family, and typically they like it to be immediate family. I think the furthest I've seen on the family web, if you will, is an uncle or an aunt. But cousins and things like that, it's a no-go. All right, they want to try and keep it somewhat close to the borrower. Okay. For the HomeReady program, what is the max that I can make? Great question. That has fluctuated, and it kind of depends on the situation, if you're an individual versus if it's you and a spouse. And it also depends on your overall situation in general as it pertains to family, kids, this and that. So it's a bit of a sliding scale. I will tell you, I believe like an individual, single individual, I believe the max threshold is $75,000. Okay, but I can look that up for you. Okay, so for the homebuyer program, do I need to have a specific income, or will any income suffice? Any income is fine as long as it's provable. Okay, in other words, it can be fixed income, it could be retirement funds, it could be Social Security, disability, alimony, child support, W-2, pay stub income. If you are self-employed, we'll look at tax returns to substantiate your income. It just has to be traceable. It it has to be provable. It has to be able to be substantiated in some kind of document, legal document, and as long as it is, you're golden, okay? If you come to me and say, I'm making this amount per month, but you can't back it up with anything, can I use it, okay? A couple quick things on that. If you're self-employed, it has to be at least 2 years tax return showing that you're self-employed for 2 years, okay? So somebody could be killing it at maybe you opened up your own business and you're crushing it and you're 8 months in. I'm afraid you have to have at least 2 years before I could use it, no matter how well you're doing, okay? Just wanted to speak to that real quick. Next question. Does it have to be new money, or can we transfer from an existing loan for a home buyer's savings account? When we say, just to clarify that, does it have to be new money or to transfer from an existing loan for the home buyer's savings account? As long as you're putting $100 a month in there, that's the minimum for the home buyer savings account. I don't believe that they're going to go too deep into the source. I mean, if you have the money and you're designating to that account month to month, I believe we're satisfied with that. I've not heard anybody say to me, hey, listen, where'd you get that money? You know, listen, if you're putting money in there and you're putting currency in there, you know, $100 a month, and you're following the guidelines of the program, you should be fine. Next question. What is the lowest credit score I can have to apply for a mortgage? If my credit score is around 600, but I have the 20% down payment. Terrific question. I kind of went over this in the home buying webinar. Everybody has 3 credit scores. You have an Experian, Equifax, and TransUnion score. What mortgage lenders go by is the middle score, because there's always been the chatter and the rumors, like, is there, is it an aggregate? Do they take the high? Do they take the low? Is it, do they blend it? No. They take your middle score, whatever the middle number is, okay? And the lowest you can have, okay, with the conforming, the conventional programs that we offer is 620. You got to be at least a 620, okay? If you're at 600, and it doesn't matter how much of a down payment you have, I mean, we'll look at it. We don't like to turn anybody away. I'm not going to sit here and say, if you don't have a 620, we're not going to look at you. That's not true. We will run it up the proverbial flagpole. We'll have our manager look at it if you have, a solid amount of money down and you have good income. We're not looking to tell people no. But I will tell you that there's a vast percentage that if you have below a 620, it's not going to be too likely we're going to be able to do a loan. But it's not hard to get that score up 20, 15 points in a short amount of time, okay? And again, talk to us and we can help you with that. Next question, the difference between pre-qual and a pre-approval. Okay, again, good question, something we kind of talked about in the original webinar. Here it is. The pre-qualification letter is based off of what an individual enters on the application along with their credit score, okay? When you do a mortgage app, we pull your credit, okay, that's legit, we have the credit, we have the FICO score. Then the rest of the pre-qual, as far as qualifying you, is saying, okay, I work at AT&T, I make $10,000 a month, okay, cool, that fits on that's income ratio side, that 43% that we talked about earlier. And then they say, and I have $50,000 in my Greater Alliance account. Now I'll look at that and say, okay, there's no reason for them to lie to me. I'm going to put this pre-qual letter together based on my calculations and their credit score and all this, and what they put on the application. And looking at that, does it look like they could afford this $200,000 mortgage? Yes. Okay, sweet. I'm going to send you a pre-qualification letter. Now, again, that letter is predicated upon me simply taking the information that was placed on the application and not verifying pretty much any of it. I mean, the credit report obviously is going to tell me your true credit score, but I don't know if you legitimately have $50,000 at Greater Alliance, or if you actually are making $10,000 a month as an executive at AT&T. I'm going on the premise that you're telling the truth, so I can write you a pre-qual letter. Now, if you want a pre-approval letter, it's a stronger letter, okay? A pre-approval letter means that I've gone the next step with you, and you said to me, hey, Patrick, here are pay stubs, and here's my W-2 from last year from AT&T showing you that I am making, in fact, $10K a month at AT&T. And by the way, I've also enclosed a bank statement, my savings account statement from Greater Alliance, showing the $50,000 in there. Okay, now you've come to the table and said, not only did I tell you I had it, but I backed it up with incontrovertible documentation to substantiate it. Now give me my pre-approval letter. And then, yes, I can write a pre-approval letter. So the difference between the two is simply, with the pre-approval, you've shown me the money. I'll let Jerry Maguire. Okay, you backed it up. This is what I put on my application, and here's proof of it. So it's a stronger letter versus a pre-qual. But I will tell you, pre-quals work just fine too. Okay, a lot of people go shopping for houses on the weekends, and they find one they fall in love with. It happens just like that, and and they want to make an offer immediately on the house, they're not walking around with pay stubs and W-2s in their pocket. So we do the pre-qual, and then if the seller says, hey, I like the pre-qual, could you get me a pre-approval so I feel a little bit more comfortable and you look stronger and we do this deal? Yeah, you come back and we can up it to a pre-approval letter. Okay? And they are good, both of them, just so you know, and that's the next question popping here. Pre-quals are good for 120 days, which is basically the equivalent shelf life, if you will, of a credit report. So you basically have 4 months once you get that letter to go shop around. All right? So again, I think that's it. I think we've covered everybody's questions. Again, thank you all very much for participating and allowing me to share some of your time with me.
And I just want to, before we head out, I just want to let you know that at the end of the webinar, and then even in the email that you'll get in an hour after the webinar, there is a survey that we would love for you to fill out so we can make the webinar experience even better. And as an added incentive, we're giving out a $25 free Visa gift card to one lucky winner. All you have to do is complete the survey. It should only take you like maybe a few minutes, and at most, so it should be very easy to go through. And you have a chance to win $25. So it's definitely worth trying it out, and we really appreciate the feedback for that. And once again, we really appreciate you just coming and joining us for this webinar. We hope you had a lot of value with this. If you have some time, we would love if you could like us on Facebook, follow us on Twitter, or check us out, subscribe to us on YouTube. We're actually having this cool sponsorship on our Facebook where if you like our page, you have a chance to win a free dollhouse, so you can check that out too. So it's just a little bit added incentive to like us on Facebook as well. Just to remind you, you will get a link to this recorded webinar in a follow-up email shortly after this, maybe about an hour in. And then if you found value out of this and you want to learn more information about the buying and closing process, we do have another webinar next Wednesday, May 23rd at 12 o'clock. So just go to www.greateralliance.org/webinars to register for that, and that should be a great time as well. So again, thanks for attending and have a great rest of the day.